This is not financial or investment advice. The information provided is for educational and entertainment purposes only. Please always do your own research and consult with a licensed financial advisor before making any investment decisions. Thank you, guys.
Hello, everybody. Welcome back. And today we're going to be talking about taxes and how not to pay them. So if you've ever wondered how the rich buy real estate, collect rent, build wealth, and still pay no taxes, or if you hear on news headlines how somebody paid 3% in taxes last year and you have no idea how they do it, I'm going to share one strategy that the ultra wealthy use in order to pay no taxes. And this is the strategy that I think is best as well. There are three, I put up four fingers, but there are three that I know of. And I think this one is the best, because you do not have to take on debt to do it. But we'll get into that later. So let's say you own $1 million rental property. And this is why that most people can't take advantage of some of these they're not necessarily loopholes, but things that are written into the tax code that are very advantageous to property owners. You need $1 million properties, right? Or you need to own property. And it's very difficult for average people to just go out and just start buying real estate in order to take advantage of these rules. So when you own a rental property in real estate, it typically generates cash flow. So if you own $1 million property, it is not unrealistic to think that that property will make you $60,000 a year in net operating income. So that is pure cash flow. That is money that goes straight to your bank account. So this would be a 6% capitalization rate or 6% cap rate. That's pretty typical. But there's an extra step. In the eyes of the IRS, a house or a structure has what's called an economic life. And for a single family residence, rental property, that economic life is 27 and a half years. So what does that mean? That means that over a span of 27 and a half years, let's say your property is assessed at $1 million. That means over 27 and a half years, you get to depreciate that $1 million to zero, which leaves you at 3.66 roughly percent every year of depreciation. Now, to just do the math on that really quick, if you're generating $60,000 a year on $1 million property and it's assessed at $1 million, you get to write off $36,000 a year on your taxes. So effectively, you're only paying $24,000 a year on taxes, even though you're making $60,000. So that's pretty incredible. Already, you're paying less than half of what you make. You're paying taxes on less than half of what you make because of depreciation. Because in the eyes of the government, you're providing housing for people and you get tax benefits for that. But what if you could deduct more than 3.66% a year, right? This is where cost segregation and bonus depreciation comes in. So let's go back to this $1 million property hypothetical. Let's say the land is assessed at $200,000 and the structure is assessed at $800,000. This is a pretty realistic situation. Now, land you cannot depreciate. In the eyes of the government, land is not something that deteriorates over time, and it doesn't have an economic life. Land is forever. So you can't deduct that amount on the taxes. So if you have a land value of $200,000, that means that you have a structural value of $800,000. And that's what you can depreciate over the 27 and a half years. So let's say you do a cost segregation study. Now, a cost segregation study means that you have somebody come in and assess every single item in your property. So they assess the economic life of your couch, of the carpet, of the sidewalk, your tree, your fixtures, your appliances, everything. And those can be broken up into different depreciation cycles. So let's take your carpet, for example, because this is an easier one to understand. There are 5-year, 15-year, and 7-year depreciation cycles that they can be broken up into. And it's all up to the discretion of whoever comes in and assesses those items. But on your carpet, that would probably have a 5-year depreciation cycle, because after 5 years, the carpet's been used, you might need another one. Now, if you've spent $1,000 on this carpet, that means on a 5-year depreciation cycle, you get to write off 20% of its assessed value every year. Now, this is really incredible. So that means when you do one of these cost segregation studies, instead of just having the whole blanket as 27 and a half years, you get to have a bunch of things that are 5 years, maybe things that are 15 years. So if we're going back to our $1 million example, maybe $150,000 worth of items is in the 5-year depreciation cycle category, and then maybe $100,000 is in the 15-year, and maybe some stuff in between, and then the $550,000, which is going to be your roof, your walls, the physical structure itself, is still going to be in that 27.5-year depreciation cycle. So if we look at this little chart that I put together, and these are all just hypothetical numbers, obviously they pan out differently in real life. But if we look at this, on the 5-year property, you've got about $150,000, 15 years, you got $100,000, and then the 27.5, you have $550,000, just for simplicity's sake, so that we can understand how this works. So on the 5-year property, $150,000 divided by 5 would be $30,000 a year. 15-year property, $100,000 divided by 15, $6,600 a year. And then the 27.5, 550 divided by 27.5 gets you $20,000 a year. So your total depreciation in year 1 is going to be $30,000 plus $6,600 plus $20,000, which puts you at $56,667. So that means in your first year on this property that generates $60,000, you almost get to write off the entire income amount, which is pretty ridiculous, right? So you're only paying taxes on $4,000 of your $60,000 income just by owning this property. Now, there is a catch to this. Obviously, on these 5-year cycles, since you accelerate the depreciation timelines after those 5 years are done, you can no longer depreciate that amount. So what it effectively does is that instead of doing a flat line for 27.5 years, you front load the depreciation for those first 5 to 7 to 15 years, and then it kind of tapers off in these like tiered little stairs. And I'll show what that looks like right here. So this is what the breakdown of the depreciation looks like over 30 years with your standard versus cost segregation strategies. So you can see that this little yellow line here is your standard depreciation, and then this dotted line is that cost segregation with that tiered. And you can see that after 5 years, it starts to drop off, and then 15 years, it'll drop off, and it kind of goes down in this stair-like format. Now, you might be looking at this orange line here that starts at $250,000 and be wondering what it is. That's called bonus depreciation, and we're going to get into that in a moment. But this chart was really just to help you visualize what those depreciation schedules look like over a 30-year timeline. So you can do something a step further, which is called bonus depreciation. So anything that is under 20 years, right? So your carpet, that's 5 years, or your appliances, that's 7 years, or 10 years, or 15 years. Anything that's under that 20-year depreciation cycle, 80% of it can be depreciated within the first year. As of 2023, bonus depreciation allows you to immediately write off 80% of qualifying assets, so property with a useful life of under 20 years, like 5-year and 15-year assets, in year 1. So we'll keep using this same property example, but now with the bonus depreciation. Your total purchase is $1 million. Your land, which is non-depreciable, is $200,000, which leaves you $800,000 of depreciable asset. But now you have the bonus on top of your cost segregation study. So your 5-year property, which is $150,000, back to that chart we looked at earlier, is eligible for the bonus. Your 15-year property, which is $100,000, is eligible for the bonus. With the 80% depreciation as of 2023, in year 1, you're going to be deducting $200,000 from your income. But wait, that's more than I'm making, right? So not only does that mean I do not pay taxes on the income of my property, but I now have what's called a paper loss with the IRS. And what that means is that I can roll that debt essentially that I have into the next year. So if I make $60,000, In year one, I get to write off $200,000 of depreciation. After I make $60,000, I still have $140,000 left, which means I get to carry it into the next year. And then after that, I still have $80,000, so on and so forth. And on top of all of this, you still get to do the 27.5-year depreciation schedule for things like your roof and the physical structure as well. So at the end of year one, you're able to depreciate a total of $227,000. We can just do a little comparison here. A standard 27.5-year depreciation cycle is $29,000 a year. And by the way, this is still incredible. Even if you're just to do the standard, you minimize your tax exposure by almost half of what you're making, which is incredible. And then there's the cost segregation with no bonus, which is $56,000. And then there's the cost segregation with bonus, which is $227,000. Please note that this is only for year one. And after year one, that drops dramatically for the ones that you use the bonus because you front loaded so much of your depreciable amounts in that first year. But this is where it really makes a difference. If you look at a 5-year chart, on the standard, you get to depreciate a total of $145,000. On the cost segregation with no bonus over a 5-year time period, you get to depreciate $283,000. And on the cost segregation with the bonus depreciation, you get to depreciate about $297,000. So over a 5-year time span, it still makes sense to do the bonus depreciation because you get to do more in total. But shoot, I've used all my depreciation, I've front loaded it, most of it's gone after I've done this bonus and this cost segregation study. And in the first 5 years, I've used most of my depreciable amounts. Darn, what am I gonna do? Eventually, I guess I'll just have to sell the property and, time to pay taxes, right? Nope. Enter the 1031 exchange. You get to defer all of your taxes by rolling your profits into another property and do it all again. You go into this next property, you do another cost segregation study, you do another bonus depreciation, you do the 5-year cycle, and then you sell and you 1031 into yet another property or maybe 2 properties. And that is how you really, really grow wealth because you're not paying taxes on any of this stuff. You're not paying taxes on how much you've made by the property appreciating in value. You're not paying taxes on any of the actual rental income that you've made because of the depreciation. And all of it is still going to your pocket, right? And most of it's going to be locked up in equity, right? Because you're buying property with this, and that $1 million you might not get in cash in your pocket, but that's when you can just put debt on the property and get a mortgage and leverage it. Just to put this in a little quick snippet, buy assets, accelerate depreciation, stack losses, defer gains, repeat. It's a beautiful cycle. It's one that you guys can utilize, that everybody can utilize. But that's how the rich pay no taxes. Not by hiding money or using these sneaky loopholes and all these things, but by understanding the game better than anyone else. Now, if you guys want a part 2 on how the rich borrow against their wealth tax-free, make sure you subscribe and leave a comment down below what you would like to see. This is one of 3 methods that I know, like I said earlier, on how to not pay taxes on your wealth. This is, in my opinion, the best method because you don't have to take out debt in order to not pay taxes on the money you're making. But yeah, let me know down in the comments below, guys, if you want to see the other 2, or if you have any general comments about any of the topics that I covered in this video. So thank you guys, and have a great day. See ya.